Can you see and hear? I'll put up my Thinkorswim window, and you guys can tell me if you see that and hear me. Although if you can't hear me, I guess you won't be able to tell me anyway. All good, Craig says, and Den says, all good. Fantastic. All right, that's one of our smoothest starts ever. All right, let's see. We are recording the meeting. That's all good. And let me see where we are now. Here we are. We're still up pretty good for the day, 1.5%. But you got to keep in perspective that 1.5% is really not a big deal because we've been down so much. It's very easy to get confused when you make gains and the TV people all start going, yay, yay, markets rally, boom, boom, boom. But the reality is this is nothing. This is why we hammer that concept of bounces into your head. Weak bounce, strong bounce. You know, because if it isn't a bounce, who the hell cares? All right, so let's take a look at SPY. SPX won't give us this little chart, which I like. Okay. So it's all about perspective, okay? This is why I like the gallery view. This is stockcharts.com. It's free. And I use the gallery view where you choose it over here. It says gallery view, and then you punch in the thing you want. And so if I do SPX, I'm pretty sure it doesn't give me the same daily. So let me take a quick look just in case it does. Oh, it does. Okay. Well, that's much nicer then. All right. So this is the actual S&P, not the futures S&P, because ES is currently at 1950, although they're pretty much, they're going to be lined up because these futures expire shortly. So, the futures contracts, the September ones are being traded now as the front month. They expire on options expiration day in 10 days, not 10 days, well, whatever the amount is. Probably it's 10 days. Look at that. Let's just go with my instincts and pretend I checked. It is 10 days. Okay. So on the 18th, these contracts expire. And because the futures contract is only 10 days away from today, there's not going to be a lot of variance between the price of the futures and the price of the actual S&P. When the contracts roll over, though, these contracts are always a prediction of where the S&P will be on expiration day, not where it is today. And that's why you see those variances between the futures and the thing. It's kind of useful, actually, you know, when you're 3 months out and you get the sentiment of what the futures are. So when you look at the December contracts, which will be the next ones as they roll over, they're either going to be higher or lower than the actual S&P. If they're lower, it means there's quite a large, any amount higher or lower means there's quite a lot of people. When you look at the major futures like the S&P, it means there's a lot of people who believe the S&P will go lower or higher. It doesn't mean there's a few. It means that there's a huge amount of major fund betting saying we think we're going to be a bit lower in December or we think we'll be a bit higher in December. So that's a very, very telling number where the next futures contract ends up. And right now, let me see if I can even find it. SPX, I'm doing it on my other machine. December, how can you tell what the current price is? I can't tell, frankly, I'm sorry. Anyway, so I can't tell what the Decembers are currently. I don't know what the number is. If anyone knows, feel free to say. But anyway, so either people have a sentiment it's going to go lower or higher. So right now there's no sentiment because it expires next Friday. So whatever it is today is what people kind of think it's going to be. So and anytime that changes, the futures bet change to go with it. So anyway, so here's your daily view. Now in your daily view, you'd say, oh, we're rallying. Look at this rally. We went way up there. First of all, this is completely bullshit because you went up on no volume. It was a pre-market move up, means nothing. So what actually happened today? We popped a little at the close, sold off, drifted, now a little pop, and we're drifting again. That's not an exciting day. I don't care that it says up 1.16%. We're up 1.6% on nothing, on a pre-market pop. It's completely meaningless. I mean, it's better than being down 1.6%, but it really is not something you should go by. Now, as you move to the bigger picture, and this is why I love stock charts, because it's daily view, weekly view, basically, and monthlies, monthly view. Now, this is a weekly chart and daily chart, but obviously in the daily view, you get a pretty good, each of these little boxes are weeks. So I like looking at them that way. So what's actually happening? What's actually happening is we were drifting along here. We failed. We have our death cross, which we knew was a bad thing, right? We knew that right there. I wrote a whole big article about how bad this was, and look what happened since. But we went in here, we death crossed, we had a big failure here that was caught everyone by surprise, came back, but it was too late because we already death crossed, and now the pressure is down on the 50-day moving average. Okay, we're really not going to make a meaningful move up until the 50-day moving average meets us around 2,000, if we're lucky, if we're bullish, but that's going to take how long? We're at 1950 here. This went from 2,100 to 2,000 in 2 weeks. See, 2 boxes is 2 weeks. So in 2 weeks, we went down 50. So we're going to go down another 50 in 2 more weeks, which is right on option expiration days. It'll be very exciting. So it's going to take the 50-day moving average 2 weeks to come down. This is what charts are useful for. If you actually understand how charts are drawn, then you can predict the future. Instead of looking at them and figuring out what happened in the past, you have to think about how they draw out in the future, what kind of behavior. So unless the S&P is firmly over 2,000 and really starts getting over 2050, 2025 in the next week, 75-point move, that's quite a lot. This is only 30 today, and everybody's impressed. So unless we go up another 75 points in the next 7 days, which is not that likely, that means 3 out of 4 days we have to have moves like today. Unless that happens, we're going to be the 50-day moving average sometime next week, right around option expiration day on Friday, is going to bang into the current daily moves, probably around the 2,000 line. That is going to be there's going to be a lot of pressure there. Think about this line coming up. It's meeting this resistance. It's heading down. Also, while this is happening, this 200-day moving average, since we're always below it, we're pulling it down lower every day, okay, only by 1/200th of the difference between this line and this line. That's why it's a 200-day moving average. Every day, the difference of, 125 points. So almost a point a day, though. This thing is actually dropping about 1 point a day if we're down at 1950. It's 125 points spread on 200 days, so half a point a day, really, a little more. So in 2 weeks, I can already tell you that if we stay at 1950 in 2 weeks, this guy's going to drop about 5 or 6 points. No, he'll drop, let's say 7, 8 points. So he'll be down at about 2070, 2065. This guy is going to drop 1/50th. He drops 1/50th of the difference of 100, so he's dropping 2 points per day. And as long as we're down around here, he's going to drop down 2 points per day. In the next 10 days, it's going to be 20 points down. And he'll be down about 2030, right about this 2025 line. Okay, so that's how this is going to go. This guy's going to fall down this far, and that's even if we're improving. If we go down further, he'll pull down more. And the trajectory he's on, the average he's on, says that on the average, we don't actually perform this well. In the last 50 days, the chances are that we're not going to do better because in the last 50 days, our average has been more than down 2 points a day. Our average has been down 50 points in the last 10 days. That's 5 points a day drop. So the 50-day moving average is telling us, this is the thing, it's completely backwards from what you're used to thinking about with charts. If you want to know, because everything you know about charts is based on figuring out what already happened. And what I'm trying to tell you to do is how to figure out what's going to happen. And to figure out what's going to happen, you have to understand how the lines are drawn, why they're drawn, and what affects them. So since these averages are hard to change, and this average says you're dropping at a rate of 5 points a day, and since you want to see an improvement that indicates that you're going to improve more than 2 points a day, that means that means that this is nothing. We got to get a real move on here. We got to be back over 2,000 pronto, or this is going to fail. And that statement there, that we have to be back over 2,000 pronto, is the whole concept of bounces. Okay, that's what the bounce lines are all about. When you have a fall, you're going to start affecting, and it goes for the smaller terms and any term, whatever term you're looking at. The point is, when you have a fall, you've got to bounce. And if you bounce strong, you'll have a chance of reversing the downtrending averages. And I'm not just talking about the 50s. There's 20 days, 10 days, 5 days. There's all kinds of averages. But, you know, we're not looking at those. But when you have a fall, if you don't have a strong bounce, and this is kind of a strong bounce, but it didn't hold, when you have a strong bounce, you have a chance of reversing the downtrend. When you fail your strong bounce, you're not reversing the downtrend, you're at a weak bounce. And if you fail the weak bounce, you're accelerating the downtrend. Those are the three possibilities, right? You're either going to have a strong bounce and break over it, and you're going to reverse your downtrend, and that means you can start getting bullish because the chart of the future is going to get more bullish. And if you're neutral, if you have a weak bounce, if you're not a strong bounce and you weak bounce, then nothing. You're basically just watching to see how it resolves itself. And if you have a weak bounce that fails and you start going down, then you know that now the whole thing is collapsing on you and the trends are moving down and the lines are going to move down and it's going to be harder and harder for you to make a recovery. That's why we look at the strong bounce lines and the weak bounce lines. That's the whole purpose to those things. It's a simple way to understand exactly what I just told you. Okay, but it's all about having perspective and getting your head out of looking at these old things. It doesn't matter. I don't care what happened in the past. It doesn't matter. What matters is what's going to happen. I'm not betting on the past. I'm betting on what's going to happen down the road. Now, when you zoom out another level and you get to here, now you see how really pathetic this is because we're not bouncing at all. This is just making a little stair-steppy pattern. You've seen these. This is a little stair-steppy pattern that says we are going down and down and down. And if we don't get over this, which is back to 2000 again, we're going down. And where's our strong bounce line? Now let's go back. I'm going to go all the way back. I'm going to explain to you how easy this is once you understand how it works. Let's go all the way back to 825. Where I said we have to gain 3% today or bust, right? What's the bounce lines on the S&P? Oh, wait. Oh, don't tell me I didn't do bounce lines. Here they are. Yeah, sure. See, I know myself. I know that if we had a tremendous market fall off on 824, then on 825, I must have calculated the bounce lines. So here we are, S&P 2100. I said this on 825. I didn't say this today. Okay, a weak bounce. So we fell from 2100 to 1800, and that makes 250 points. 20% of 250 points is 50 points. So 50 points plus 1850 is a weak bounce at 1900, and 50 more points on 1900 is 1950 is our strong bounce line. And it turned out that 1942.50 was our 5% line anyway on the big chart. Wherever the big chart is, here's the big chart. See 1942.50, we tested 1850. The strong bounce line was basically 1942.50. We needed a 5% move back up in order to be happy with the S&P. What actually happened? What actually happened, we can see on the daily chart, is we briefly went above 1950, but look what? Only for one close, two close, and by the third day we were already trending back down, and by the fourth day we failed it. All right, that's why I didn't jump on board and get all bullish. In fact, I at the time said, let's take advantage of this and get the hell out. Because and that's another problem because I'm not a chart guy. You got to remember that. I don't believe in charts, but I use them because everybody else does. It's an indicator. But just because we went up here, it's the way we went up there. We went up there on bullshit stimulus talk and some other crap, and it wasn't a real rally. You can tell the difference between and there wasn't the volume that you would have wanted to see in a real rally. So we went up here. This was a great spot to get out. We kept short. And here, and then finally last week, when we popped up, I said, let's get the hell out and cash in because this is again, we weren't even making it back to this stupid level. We were still going down. And because in my head, this is what I see. I see this in my mind. I can tell that this is happening. But I can tell because I know how charts get drawn, and I can see that we're not even really making good technicals when we do that. We're still, and you can see it on the weekly chart here. You can see that basically it doesn't matter what you think you're seeing today. All it is a pathetic attempt to break back over the 1950 line that's failing. That's all this is. And on the whole, that actually makes a very negative looking chart from candle perspective. And I'm no candle expert. I couldn't tell you what those patterns are called. I call them thingamajigs and whatchamacallits. But that's where we are. So, but the point being that understanding how these things are made and how they're going to be formed down the road, that's the key to understanding how these chart patterns work. All right, let's see if you have any comments on that incredibly interesting subject. Here we go. Ooh, people are chatting. Let's see what happened. Okay. Go to trade on all O products, key in TF, and check all futures. What are you talking about? Joe, I have no idea what that's a reference to, unfortunately, because I'm coming in late, but I bet that was probably a good hint for me to do something. Could you please tell me where you want me to do that? Is there any explanation for the wild swings in oil up and down, and then down $2 in a few hours? Yes, oil is manipulated crap that makes no sense. And that's why I said we should avoid it. it's in an in-between spot right now. There's no way to predict it, and any kind of rumor one way or another on what OPEC's going to do or not going to do is going to send it flying up and down. The closer we get to the meeting, the more it's going to get crazy. Next, contract and prices. And Thinkorswim. I see what you mean. Go to trade all products. Got that. Key in TF. I was really looking at ES. But okay. ES. And check the futures. Oh, I see, and it is ES. Oh, thank you, I get it. So it's ES H6, I guess, right? So ES H6. So what he's saying, that's right. So he's saying if you put in the general contract in the futures in Thinkorswim, I'll show you where. This is a very good hint, which I should have realized. You know what I did? I put in SPX, like an idiot, which was why it didn't work. ES, I get confused going from one thing to the other. So he said go to ES, then find the month you want to talk about, which in this case was December. That'll be the next quarterly contract. And now we know it's ESH6. Now we put in specifically ESH6 over here, and now it's going to show us where it's priced. And it's priced at $19.35. Dum, 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 dum. So 1935 is 15 points below where we are now. Now, isn't that funny? Because Barron's is telling us that we're going to finish the year at 2100. Yet the people, that's a bunch of moron analysts who are paid to pump up the market, okay? People who actually put their money in the market and place gigantic multi-million-dollar futures contract trades, they say 1935. That's a very, 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 very big discrepancy to where Barron's is. Now, granted, that's up 30 points from where it was yesterday, but meanwhile, they're still trading below. So they are not as enthusiastic as the current S&P would have you believe. All right, so that was good. Thank you, Joe. That was very helpful, and that was exactly what I wanted to talk about earlier. All right, next. All right, Craig, we know oil is stupid. That's why we're not even bothering with it today. Wayne says, hi, Phil. Use both the futures and the indexes support and resistance 5%. Why both? When do you use each? Asking your rationale. Well, really, Wayne, it's because no. If we're talking about charts, I'm going to use the numbers from the charts, right, which are the standard numbers. For betting purposes, which we of course care about, I'm going to use the futures, because we're betting on the futures. We're not betting on the chart. So, and again, that goes back to that discrepancy that you have between the futures and the chart. So if I were betting on the December contract, it wouldn't do you any good if I told you 1950 was the bounce line, because it's 15 points below that for the bounce line. So 1935 would be the bounce line, which interestingly, obviously in December, is where it is. So that's why. You have to be internally consistent to where you're betting. If I'm betting an option contract, I want to bet on the underlying that the option contract's based on and chart that. I can't chart just some random thing. And the futures, because there is that discrepancy, I'll tend to switch from one to the other depending on the discussion, because I can't change the chart. Well, I can, but realistically, our big chart charts the actual indexes, and when I'm talking to the general public, which I do in the daily post, I'm generally going to be talking about things that they're looking at, which is the outside. They're looking from the outside of the charts, and they're looking at the daily tickers and so on and so forth. When I'm talking to you guys in chat, I'll end up talking about the futures and those numbers, because those are the ones that we care about for betting purposes. So I hope that's clear in my unclearness as to why I flip back and forth. And sometimes I do forget to differentiate them, which is bad. So it's always good to ask. Alice there says, oh, darn it. There's no way to make that not do that, I guess. Okay. Speaking of views, is it possible to show us briefly the thinkorswim chart setup you're using your futures active trader? Sure. I use a lot, though. So you have to understand, it's tricky because I use a lot of screens. Like, this is one of my 3 concurrently running sessions on thinkorswim. I have one running on my Apple, which is, what has it got? It's got all, like, momentum stocks. I can call them out to you if you want. It's, I have Tesla, SolarCity, Apple, TLT, Sears, Shield, USO, I have CLF, I have AVX, I have LQNT, I have Starbucks, I have Gold, GLD, DTU, TZA, I have Soda for some reason. I don't know why I have Soda. I think sometimes I just put in ones I'm watching on that one. I have Amazon and Cliff CLF. We have Netflix, of course. Now, there's also positioning, because Netflix is in my top right-hand corner, closest to, it's my left screen, and it's in my top right corner, so it's closest to my head, because I always want to know what Netflix is doing. I have the Nikkei. I have Apple again, so I must have been watching Apple. And I have the dollar. So, sometimes I switch things to what they are. On my other thinkorswim session, I have all the indexes at the top. This is on my left side of my desk. So I have the Dow, the S&P, the NASDAQ, and the Russell on the top 4. Then I have oil, gold. These are the indexes, CLYG. Then I have XLF and the Nikkei, NKD. And then the final row of 4, I've got the dollar, the VIX, Brent, and gasoline. So those are my left. Those are closer to my left hand on the left screen to my front left. And then this screen that you're looking at is my far right screen, which is really just a seminar screen, but I leave this up all the time. This is the chart I leave. These are the charts I leave up on my seminar screen whenever I'm not doing a seminar. And this is, of course, Dow, S&P, NASDAQ, Russell, Nikkei, Apple, TLT, silver, gold, dollar, oil, Brent, natural gas, gasoline, and the VIX. But then I have my active trader platform. So then you go to trade and active trader. And now these vary. I wouldn't call this anything. I mean, this is whatever I happen to be trading, I'll put up the pair trades for those. So I want to see what else is going on. So in this case, I was last trading gasoline, and I was looking at the dollar, and I was looking at the Russell, and I was looking at ES. I wasn't even looking at oil when I was doing this. Usually I'm going to look at the dollar plus a couple of indexes, depending on what I'm trading at the time. And this is usually my hot window, this one or this one. I almost never trade in these windows. Meanwhile, we didn't even talk about it. Is there any good setups? He was a good setup here at 160. Wow, when did that happen? You missed that. We missed that. I still think these guys are all going to curl over. We talked about that earlier. And we're short on the S&P at 1950, I think, was the lagging trade we called there. Oh, look how far he fell from 42.75. He fell 25 points already. Nasty. So where are we? Okay, that was that question. Sorry. iTunes, go away. Close. Okay, back to this. It depends what you're trading to a large part, but I'm just generally going to watch the indexes. I'm going to watch the oils because, it gives you an idea of something happening around the world. If oil prices go crazy, that gives you a real fast idea if something's wrong. Also, like this morning, in fact, today I observed when the markets were rocketing up in the morning, I observed during our member chat room first thing in the morning. I said, well, the markets are going up, but oil's not up and gold's not up. And if oil and gold aren't up and gasoline's not up, then what kind of rally is this? Okay, if people really believe there's a recovery and good things are happening, then it shouldn't be just the market that goes up. Then the stuff the market is made of should go up. In other words, the things that power the market should go up. And that wasn't happening. So if oil's not going to go up with the market, that means this rally isn't based on any fundamentals. It's just based on somebody's going to pump more money into the market. That's not a market. That's not what I want to bet on. I want to see a real recovery with real manufacturing improvement and real production improvements. I don't want to see rallies based on somebody's going to dump $200 billion more into China and jack up their market prices. That has nothing to do with value at all. And I mean, I said it over and over again, between 3,000 and 5,000 on the Shanghai, and now it's back to 2,500. I mean, I don't know how many times I could say it. It's not a real rally. It's full of air. And if you get involved in those kind of rallies, you're subject to exactly what happened to the people in China. You just get completely screwed out of your positions, and you have no idea what happened. And even worse, then you start believing that things are going to bounce back. Why would they bounce back? Unless somebody puts in a boatload of money again, they're not going to bounce back either, because those prices were never real. You know, when a stock, look, like Netflix, for example. Netflix went up to $130. It should never have been $130. And so when it falls down to $95, that doesn't make it a bargain. It's not a bargain. $130 was stupid. It never should have happened. You know what it's like? It's like if you get shot, okay, and you have a bullet hole in you, and you lose 2 pints of blood or 3 pints of blood in 5 minutes, okay? Is that your natural state? It's like, no, because you got shot. You had a hole in you and blood poured out. When they close the hole, you go back to your natural state, which is blood doesn't pour out of you at the rate of a pint per minute or something like that. That's your natural state. It's always, and so you can't follow a person around who got shot and keep betting that they're going to start spouting blood. It's not going to go back to that. He only got shot the one time, you know, because something affected him outside of normal. All right? And that's the same thing when you start chasing these stocks and thinking they're going to bounce, especially these momentum stocks. They don't bounce because they never should have been that high. There was an aberration that pushed them to a certain height, but once people start realizing the proper value of the thing, it's very hard to ever get them back to that height, because now people are onto it and suspicious. All right, next. All right. Wait. Oh, something here. Speaking of use, can you show us briefly the TOS setups? We did that. Prices. ABX, I don't know where I got mixed up on this. Okay, anyway. Attila says, could you share your current view on ABX, please? All right, let's take a look at ABX. ABX is Barrick Gold, of course. And look, my view on ABX is pretty simple. These guys they're currently at $6, okay? Where's Yahoo? Do we have Yahoo somewhere here? No Yahoo. That's because Yahoo broke the computer last time, didn't it? But maybe not this part. Yahoo, there it is. ABX. Okay. They're marking $0.5 billion on ABX, okay? But if you look at their profile, I think it'll tell you, maybe it will, maybe it won't. They have 93 million ounces. They used to have 140 million. They sold 50 million ounces in the last year. That's not good. But nonetheless, they still had 93 million ounces of gold and 9.6 billion pounds of copper, but we don't even care about that. We'll just talk about the 93 million ounces of gold, okay? So, here's a company that's trading at $7.5 billion that has 93 million, 123 ounces of gold. Gold is currently $1,120 per ounce. So they have $104 billion worth of gold. That's a lot of gold. Okay? Now, the problem is, though, it costs them money to pull this gold out of the ground. Currently, their extraction cost is roughly $1,050. That means they're only making, if gold is $11.20, they're only making $70 an ounce for each ounce they pull out of the ground. 70 times 93 million, whoops, is 6.5 billion. That's about what they're valued at now. So Barrick Gold is currently valued at how much profit total they could make pulling all their gold out of the ground at the current price. So why is this a good leverage bet? Well, because if gold goes up to $1,200 an ounce, oops, and you still have a cost of pulling it out of the ground at $10.50 an ounce, now you're making $150 an ounce times 93 million, and now you're a $13 billion company. If gold goes to $1,500 an ounce, whoops, well, anyways, minus 1050, now you make $450 an ounce times 93 million ounces, and now you're a $41 billion company. That's 5 times value. So if gold goes up to $1,500 an ounce, which is what, like, what is it now, $11.50? So if it goes up $400, divided by its current $1,200, no, I'm sorry, it's $300, silly me. So, wait, what is it? It's $11.20. I'm sorry, I keep getting confused by how low it is. Okay, so 380 divided by 11.20, let's do it correctly. 33%. So if gold goes up 33%, ABX goes up probably 5 times. So what you have here is you have a very, 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 very leveraged play on gold. Because they already have the gold. They already paid for the mines. They already paid for the rights to all this gold. That's all gone. That's all flushed out in the thing. And all you have now is they're sitting on an asset. And again, don't forget, we're forgetting about the copper. And 9.3 billion pounds of copper, 9.3 billion pounds of copper at $3 a pound is another $27 billion. And again, there's a cost to extract copper, but it's nothing like gold. It's I figure 50% of that's profit there. So, but they're not a copper miner. They only actually happen to own the copper in their gold mine. Because, and really, honest to them, the copper is the stuff they want to get rid of so they can get to the gold. There's a couple of points that they have sold off their assets, and apparently they've been selling off their assets at roughly $200 an ounce. That's the going rate for getting rid of gold mines. So 93 million, we'll do this again now, 93 million times $200 is $18 billion. So if they liquidated all of their gold, they could get $18 billion for all those mines roughly, okay? Now, here's the problem. Now you got to look at the balance sheet. So 18 billion minus, $12 billion from debt. And that's, again, where you get back to the valuation. 18 billion minus 12 billion is 6 billion. They're getting very little premium for their business. They're basically being priced at liquidation. I love to own things that are priced at liquidation when there's a good chance they won't have to liquidate. And they don't, because they don't have to pay off their $12 billion in debt. They only have to service it. And if you have $12 billion in debt and you're paying it off at, let's say, 6% interest rate, that means you're paying it off 1/15 per year. So that means every year they would have to sell 1/15 of their gold reserves to pay their debt. Okay, that's their worst case scenario. Now, that's not saying that's if they sold the mine entirely. Of course, what they are doing is instead they're selling the gold that comes out of the ground of these mines without selling the mine itself, and they're hopefully making enough profit to service their debt. And are they? Well, we look at the income statement, and we look at the quarterly data. You don't look at the yearly data because you want to know what's going on now. But, of course, there is no quarterly data, so that's a shame. I'm sure there's a better place to look for that kind of stuff, but it ain't here. All right? So annual data, and they're not making money. They lost $2.5 billion. I wish I could look at the quarterly data because I can't see what's going on. Anyway, so we'd have to drill down to their reports at this point and figure out what's actually happening. But the bottom line is you look at the quarterly numbers and you say, are they actually able to service this debt? Okay, is the cash flow sufficient? And you look at the cash flow number, and they were positive. They positive cash flow, positive cash flow. That's not terrible. All right, they're selling core assets to get there. But now you have to say, well, what do you believe gold is doing? Is gold permanently going to sell at $1,100 an ounce? Or is it going to, in the next, between now and 15 years, when they sold all of their assets, will gold go higher in the next 15 years? And if it does, we are looking at not a little bit of a payoff, but a tremendous, tremendous possible payoff on something like this. So our strategy with Barrick Gold, and we don't really have much of it left, I don't think, not at the moment, but our strategy with Barrick Gold in our portfolio, if I can find it, well, look, our 5% portfolio is over 5%. That's good. Must be in a long-term portfolio. That's funny because I posted that this morning. It was 4.8% from the weekend. Ooh, look at the long-term portfolio, 40%. That is a fantastic gain today. I told you that was great because we made about $20,000 from the long-term portfolio today. So we'll see what we lost in the short-term portfolio. ABX. No, look at that. We don't. Oh, really? Wow. We don't have any. That's sad. Okay, anyway. Oh, there it is. There it is. Okay. We do have the $5 calls for 2017. That's all we have. And they aren't even so far behind. What we're going to want to do eventually is sell some puts and just stick with the position. And eventually, if we end up owning, especially at $6 a share, if we end up owning 5,000 shares of Barrick Gold at $6 a share, it's $30,000. And they have a chance of going to $25 a share. Okay, and being, whatever, probably being over $120,000. That's $90,000 that we can make off of $30,000 anytime gold pops. So it becomes a great hedge against inflation. And meanwhile, while we're waiting, we can always sell some calls and do some stuff. It's like creating a dividend stock for ourselves. So I love Barrick Gold down here. I love them as long as they don't go bankrupt. And I don't think they will go bankrupt because they have so much gold that they can sell to other people. There's always somebody who wants to buy a gold mine. If thousands of years of history have taught us nothing, there's always someone who wants a gold mine. All right, next topic. Eric says, EH something is March. EHZ. Okay, well, okay, whatever. Wait, is that because I put in the wrong thing? Is that what you're saying? ESZ5? What did I say? Oops, all products EHH. That's weird. ES. What the heck? Oh, that's ES. So let me /ES. Very important. December. No, I'm sorry. It says, oh, I see. What's this? Oh, I see what I did. I saw that H there. So it's ESZ5. Let's see what that one looks like. 1943. Okay, so now that one's pretty much in line. But interestingly, let's take a look then, because what we just found out is that's only a little bit down. But you're saying I did something wrong, and I looked at like this March or something. March is H6. ES. Let's see what that one looks like. H6. And that one's 1935. Okay, so I accidentally found March is what I did before. But still, the point being, the long-term trends for the S&P are lower in December and even lower than that in March. Still not that particularly good. But not as low, not as drastically low as we were looking at. Thanks, Eric and Dennis. All right. Always check my work. doing like 50 things here. Sometimes I get it screwed up. All right. Chris says, can you provide guidance on entering and exiting futures trades? I follow tugboats, but get bounced by stakes. Wow. Well, I mean, that's a long-term, ongoing thing. We're not really doing futures today. Maybe next one we'll do a futures webinar, sort of. But futures trading, I mean, and especially if you go back in our webinar catalog, which on the site somewhere, God knows where, in our education section maybe, in the archives, there's a whole thing of all of our webinars is put somewhere. And I'm sure Greg will put it in chat later. Or put it here if he's on. But you can go back and read our archives. The girls have lately started adding descriptions to the archives, so now you can actually see at each timestamp where we are, but that's a new thing. But starting from now on, we're always going to timestamp what we talked about during the seminar, so it'll be easy for reference. But there are many seminars where we talk extensively about the future, so if you just go back and watch a few, you'll see something like that. But right now, I'm not doing the futures. I'll do a little bit later, but it's not a very good day to trade the futures. It's just way too choppy, and I prefer to teach, all I would be doing now is teaching some very bad habits because this is not a good time to trade them. So basically, I would look at this and say, nope, go move on and find something else to do. Deanna says, Phil, your hot screen, 4 on screen. What studies get us to 12 lines in pretty colors? Oh, okay. That's an easy answer. That study is these studies? Yeah. Wait, no. Darn it. One of these things is studies. Pattern tool, analysis tool, drawing tool, chart style, quick time, chart settings. What? Wait a minute. Oh, I know, because I got to right-click on the chart. Okay. You right-click on the chart, then you say studies down here. And the study is a trend study, and you go to P, and see way down at the bottom there, it's pivot points. So that's what this chart is. It's pivot points. And what I like, these are 10 minutes, all these charts are 10 minutes. So I'm looking at the 10-minute, 3-day intraday, 10-minute view, or 5 days, technically a 5-day view, because you can actually slide it back, but it only really kind of shows 3 days. And then you save it, by the way. The way you do it is you set up one chart the way you like it, and then you save your style. See style, and you say save style, and it says include patterns and study set. You do that, and you name it. And so I named this my 5-day with pivot points. And that way, what I do is then I load it. Let me get to this one. You say style, and you say load style. Oh, I call that 3-day. So I just say load style. So every time you make a new chart, you say load style, and it puts that style and pastes it onto the chart. So that's kind of useful. And then once you do that, though, you have to save the whole setup. Oh, I always forget how I do that. Oh, save workspace. Then you save your whole workspace so that way when Thinkorswim doesn't update, hopefully it recovers it, but sometimes it doesn't, which is really annoying. Well, I don't think it's been a long time since I had to redo all my studies, so thanks to them. All right. So anyway, so these are pivot points. I do not change any settings because to me with TA, the whole point is there's a whole bunch of people who are following these lines. If I start changing the lines and I'm making up my own, then I'm in a group of 1 looking at these charts. I want to be in the group where everybody is, so I can see that a lot of people are looking at this 1960 line on the S&P and they think that's resistance, and a lot of people are looking at this line on the Dow and this line here and they think that's resistance, and the rest will pop back up. But we know the rest will pop all over the place, so we pay no attention to it. So these lines become important. And they are good to use. And these are, Jean-Luc puts these up in the morning also. He puts up support and resistance lines and things like that. That's what these are. I'll tell you one trick, though. When you see the lines tightening up, when you see them widening, then you know that the market's going to get a little bit crazier. The volatility must be increasing because the pivot points have widened. And you can actually see that on the day when they draw the new lines. You can see how the pivot points look. When they start tightening, you're getting into a tighter range, and probably you're squeezing into an event. It's like what we call a triangle squeezy thing, where in the broader picture you'll see the action up and down. I guess we'll probably see that in the daily chart. Daily chart. Back to the S&P. And you see that? You see how we're getting in this, what you call a triangle squeezy thingy. You're kind of, the range is getting squeezed in around this 1950 line. And what's going to happen is we're going to hit a point of point of what? What the heck do you call it? A resolution. That's it. So you're going to hit some kind of point of resolution where something's going to happen. You're waiting for an event that's going to push it either out of the range up or out of the range down, but something's going to do it. Now, which it has to happen, if it's going to go up, it has to go up before it hits its 50-day, because the 50-day itself hitting a resolution point is itself going to cause a downward push. So that in itself is a negative event. Hitting a downtrending moving average becomes a negative event. Now, if you watch the action of the triangle here, up, down here, up here, we actually are resolving up around here into this 1975 area. We're not resolving down here where it's squeezing to here. So somewhere around 1975 is where it's going to either pop up or pop down. All right, and 1975, don't forget, that's halfway between our weak bounce line is 1950 and our strong bounce line. Oh, no, I'm sorry, our strong bounce line is 1950. I apologize. 1900 was our weak bounce line. We clearly held that. That's fairly bullish. Now we're at 1950 and we're pushing over that. So the next thing we want to watch for is 1975. It's a 50% move, right? Halfway between 2100 and 1850. Well, what is that? That's 350 points, right? Yeah, so 175 points. So 18, 19, well, no, actually it would be 1850 plus 175 is 1925 is 2025. So up around 2025 is 50% of the drop retraced. So all this whole area here is going to be a big point of contention. And as you can see, if it keeps going up and down here, it's going to make a little triangle, and eventually it's going to hit that 50-day moving average, and it's either going to blast through it, which it'll need a really good reason, like the Fed doing something probably, or it'll hit that and fail and start moving down, and then you'll get a very, very clear, very downtrend. All right, but this is going to be a very tough area to get over. Over this 2000 line is going to be really tough because of this, where you have that line forming over there on the weekly averages. Oops. Where am I? Here we go. All right. Hot screen. Can you share your perspective on Guild? I like Guild long term. I'm not a big advocate of them as far as it goes. I think they're a nice trade when they're cheap. They pay a good dividend. Farm Boy says they have a nice pipeline, so I like them. And honestly, it's not my field. I mean, I really pay little attention to these farmers because you have to just know all this crap about their pipeline, their drug delivery systems, what's in there. Also, what companies they bought recently, because they're constantly buying and selling each other. It's too much. You have to at some point say my brain only holds so much crap. And this is a whole area of the market I've decided not to pay much attention to, biosciences, because it's a whole field of study you'd have to get into to be playing them. So I pay attention. I know what Pfizer's doing, I know what Merck's doing, and so on and so forth, and I know a couple of good bargains when I see them. But to me, this is just a good, solid biotech firm. There's no reason they should be trading much higher than this, I don't think. I think their pipeline's strong, but I think all these guys got priced up too much with the market. And if you look at them from an ownership perspective, all right, they got a $152 billion cap, income-wise. They're dropping $12 billion to the bottom line, so that's pretty good. But the question is, why did they drop $12 billion to the bottom line? It's misleading, isn't it? They did a major acquisition. Their revenues went up from 11 to $24 billion, but you don't know that that's consistent yet, okay? It depends on how consistent those revenues are going to be. So you look over here, you see them go 6, 7, 7, 5, 8, 2, good steady growth. The profits are kind of growing along with it, so it's about 4, 4, 5. So you're looking at getting into 8, 9, 18 billion in earnings. If they can keep this up, they're going to be a good solid thing to own over time. And then you've got to look at the fact that they pay you, well, it's actually a small dividend. 1.69% is not an exciting dividend. But I think it's a solid company, and if their pipeline's good, which again, I have to defer to Farm Boy on that, but he says the pipeline's good for these guys. So it's something that I would certainly say is worth owning in a portfolio for the long term. But I'm not really enthusiastic about it because it's hard. You know, any drug failure can send these guys down sharply, and any drug success sends them up sharply. So it's kind of like Boeing, who I totally love Boeing, but frankly, I wait for a battery fire, or I wait for a crash, I wait for a wheel to fall off a plane. You know, something is going to happen at some point that's going to knock them down, like this did, right? They're on a huge roll, 45 to 84, they're almost double, and then boom, back to 63. That's like a 25% drop off here, okay? In fact, here you had them. I would have said yes to this at 86. That's exciting. You get a 25% discount on these guys, and see, here's a 25% discount, and here's a 25% discount, and here's a 25% discount. That's when you buy them. So if you want to buy Guild, I would put in an order to buy them for $85, $90 even. Okay? Now, you can do that with the options, and you can say on Guild, you say, okay, I'm willing to pay $90, so I can go to 2017. I can sell the $90 puts for $10. All right? Wow, that's a net $80 entry. In fact, the last one sold for $10.70, but let's say 10, because I like to go between the two strikes. So, so basically, you can get $10 for the 90 puts. So you promised to buy Guild for $90 in 2017. That's 103 now. So you're talking about a 10% discount or so. And they're going to pay you $10 for your trouble, and you get that in your pocket right now. So now you're buying it for net 80, which is getting to be a 20+% discount. Well, that's a good deal, right? And if you really love them, because, you know, I wouldn't buy the stock. They only, in this amount of time, they only pay you about a $2.50 dividend. So why would I buy the stock for the dividend? I'd rather just sell the put. If you want $2.50, you can sell the 60 puts. And then you get the stock at $60, which is like 40-something% off. So if you're buying the stock for the dividend, forget it. That's stupid because you can just sell the puts, and the worst thing is you buy the stock for half price. But I'd sell the 90s. You sell them for $10. Now you're net 80. And if you want to be gung-ho enthusiastic about them, I would take some of the money, not even all of it. I'd take $5 of those dollars, let's say. And I would buy the $100 calls, which is 17, and I would sell the 115 calls, which are 11, and that's 6, so you take 6 of the money. And now, wait, the 115 calls, right? So now you have a $15 spread for about $7. Wait, 9 and 17, $8. Sorry, $8. So now you have it. And don't forget, you sold these guys for 10. So you have a $2 credit here, and you have the 100, 115 spread. So you can make $15 if they're over. Not 15. You make 15 plus the 2 you have in your pocket. You make $17 if they're over 115. And the only way you lose money is if they drop below $88, and then you have to own the stock. But other than that, anything above 88. You have no cost at all. Above 90, you make $2. And as a bonus, above 100, you start making anything above 100. It goes in your pocket too. So that's not a bad way to play. It's a conservative-ish way to play the stock without owning the stock. So I frankly, I wouldn't put $100 of cash into a stock that pays me a 2% dividend. There's no point. I'd rather keep my cash on the side. All right, now let's see. Next question. Is there a trade on FCX? Well, there's always a trade on FCX. How have they been recovering? Let's take a look. They got a little bit better. You know, realize that China can get worse, and all of these guys can get worse. If people really lose faith in China, and then if Japan starts tanking with them, this might not even be the bottom for some of these guys. But long term, I still like owning the world's largest copper company, or one of them, for a very cheap price. I mean, they were very comfortably at $30 for years, you know, 25, 30, whatever. Now they're at 10. That's a discount. I don't care how you look at it. That's some kind of discount. So if you look at FCX, ooh, 6.6% today. Very nice. They're trading for $10 billion, almost 11. They lost $1 billion last year, but they have made $3 billion. So look how much they had in sales. Now what happened? They sold more, but they lost money because they're getting such crappy prices for what they're selling. They probably had to produce a lot more to get $21 billion in revenue, but they're trying to keep their market share up. So that seems to be their strategy here. And here these losses, though, these are getting horrendous, right? 282, 2.4 billion, 1.8 billion. That's not good. That's really nasty, okay? How long can they sustain that? That's really painful. It's like at some point you got to stop the bleeding. All their money is they don't have much cash. They only have $500,000 cash. Where did they get their money from? Oh, look what they did. They sold $3 billion of stock here and $3 billion of stock here and $3 billion of stock here. They've been diluting the crap out of their companies, what they've been doing, in order to maintain themselves. They sold $3 billion last quarter. These are quarters, $3 billion last quarter and $3 billion last quarter. So the numbers that you see here, they're accelerating their sale of stock tremendously. And in the last 2 quarters, they sold $7 billion worth of stock. Now, let's put that back in perspective. This is a $10 billion company that in the last 2 quarters has diluted itself by 50%. So you're looking at this chart. This is the problem with TA people. You're looking at this chart and saying, wow, what a great deal. I can get them for $10. No. You can get 1/2 as much stock as you used to get for $30 for $10, and the prospect is they're diluting it even more. Okay, you understand that? When they were at 30, they had 1/2 as much stock out. Now they have twice as much stock, so immediately the extra stock drops them to 15 or less. Meanwhile, they already dropped to 15 in 1 year, and they're projecting, and you can see it happening every quarter. They're diluting more and more and more. That means they're going to be worth $750 soon. Even if they sell the exact same amount as they sold 2 years ago, they diluted the profit across so many more shares. All right, so I changed my mind after looking at that, and I say I don't want to be an FCX. Let it find its own value and then take a look at it realistically. But this is a company that's burning cash, is diluting the crap out of themselves to pay off the cash flow and keep themselves out of trouble. But it's not a good trend. And China is doing nothing to improve manufacturing. China's doing nothing to increase what they look for. So don't get stuck looking at the charts and thinking it's going to bounce back when this is not the same company anymore. This is a company that sold, where was that treasury stock? Here you are. This is a company that sold treasury stock, treasury stock, treasury stock. And here you can see it coming up. Well, actually, no, I'm sorry. You know what, on the balance sheet? I might be wrong, because this says this is a balance sheet treasury stock. I thought that was a cash flow treasury stock. They might not be diluting as much as we think, but let's see. How many shares do they have? So now I got to do investigation. That wasn't their balance sheet. I'm sorry, that wasn't their cash flow. It was their balance sheet. They've got shares. That's what's key. They've got 1 billion shares, income-wise. They are currently losing $2 a share, $2.50 a share. That's per quarter. So in the course of this year, if you give them $10, they're going to lose $10 the way things are going. They'll lose $7, $8, whatever, but they're going to lose almost all your money that you give them this year. How are they making up for that? Now we'll look at the cash flow again and figure this out. On a quarterly basis, there's your net income. What are they doing? Why are they taking a dividend? That's ridiculous. They're borrowing money. They borrowed $2 billion here, and they're still falling short $83 million. They're also doing some weird write-off stuff. See how they're changing their inventories and changing the liabilities, and they're adjusting net income? I don't like that at all, because God knows how they're adjusting their net income or what they're doing. So you have to investigate it very carefully. But bottom line is, okay, they have 1 billion shares of stock, and the company in its best year made $3 billion going back. That's $3 a share. They're $10 a share. That would be great if they can ever get back to that. But the question is, how far do they dilute your shares between now and then? That's what you're going to have to watch out for. And here they are borrowing almost $2 billion. And you have to realize that when you buy a stock and you own it, you're borrowing the money. They're borrowing it on your behalf. You're a shareholder. So when they borrow $1.5 billion, they're borrowing $150 for every share you own. So you pay them $10, and now you're holding a share, and now they're going $150 into debt for your share. It's going to be very, very hard for them to make that money back. And this quarter, and that was last year, this year, they're borrowing another $2 per share so far. That's in 2 quarters. So they'll borrow $2 more, $4 more at the end of the year. So now what you pay $10 for is you pay $10 to be $6 in debt in the last 12 months. And now they've got to earn, and what's their best year? Their best year was earning you $3 a share. So now it's going to take them 2 years after things turn around of fantastic earnings before you break even on what they borrowed just to keep you in the shares. So not really something I'm fond of. I mean, it's not great. It's not as bad as I thought. They're not diluting as bad as I thought, but on the whole, it's not good. So it's not something super healthy. Now let's take a look at Cliffs, because CLF I like. They're iron ore. Don't forget, they're not copper. Now CLF, income statement first. $5 billion. They're actually selling less. They're not running up their production to try to keep up. They're just saying, okay, well, we're selling the same amount of crap, getting less money for it. They're showing a tremendous loss here. They did a huge write-off, though. They did a write-down, so that's a one-time thing. Generally, you'll see that won't affect their cash flow at all. See, there's no change in cash flow. They just did a paper write-off, adjustments to income of $8 billion. That's a one-time one, though. See, FTX was doing consistently. These guys did it once, one big chunk, and they took it out. On their balance sheet, they owe $3 billion here. They don't have a lot of cash. They have $300 million in cash. Let's get quarterly and see if it's more current. They have $300 million in cash. They owe the same $3 billion. So not much change. $3 billion, basically, and cash, basically the same. So the thing about CLS that I like better is that they're not bleeding cash, whereas FCX is dropping a tremendous amount of cash and has to keep borrowing to keep it up. CLS, this cash flow. CLS is just slowly bleeding cash, but that means the question is how long will they survive versus when will things turn around? Quarterly, they even made money last year in December. They made money in March, in fact, in the first quarter. All right? They're not buying their own stock. They're not screwing around. They're paying a dividend. I wish they wouldn't, but they are paying a dividend. That's a stupid thing to do, I think. There's no real shenanigans going on here. All right? So that's actually not a terrible story. That's why I like them better than FCX. You can see the difference in the balance sheet. These guys only have to hold their breath and wait until the price of steel comes back, and they can go right back to making money. They're not borrowing on your behalf. They already have debt. So they're not borrowing additionally every year, every quarter. They're not adding to the debt pile based on the fact that you gave them $4. You're giving them $4, and they're like, "Well, we're struggling to survive." So basically, you're like, "Oh, I'll give you $4," and you're struggling to survive. But that $4 puts you in for, go back to statistics, it puts you into one of 124 million shares afloat. Okay, so there's only 124 million shares. And I look back again, same thing, I just go back and look and say, okay, well, what's a good year for these guys? A good year for these guys is $360 million. They could make $2 to $3 a share. If they can survive, and down the road they can make $2 or $3 a share, and I can buy a share for $4, I like that. Don't forget, with FCX, they have to make $3 a share for 2 years just to get back to where they were when I bought it. But with Cliff, if they make $2 next year, I immediately make 50%. That's why I like them better. And they're all in precarious positions. I mean, it's just they have to be, you have to pick and choose which one you're going to take a gamble on. But they're all gambles, all these material stocks, because if China doesn't come back, who's going to step up? What's the aberration in Amazon? Well, that's an open-ended question, isn't it? Are we talking about today? Did they not go up? Is that the problem? Amazon is ridiculously priced. They should have come down. They never did. No, they went up today. They went up 3%. Amazon is a stupidly priced stock, just the way Netflix was stupidly priced, and then it got realistic. I think that Amazon will get realistic too. Of all the dumb things, Amazon announced that they're releasing a $50 iPad, or whatever you call a notebook, or what do you call a pad? I don't know. What do they call them? They're releasing a $50 pad computer, tablet. That's it, tablet. And I'm sorry, but this is the stupidest thing ever. I mean, I know their logic is that if they sell these Amazon whatever, it's like the Kindle. And how did that work out for them? It didn't work out at all, did it? Their logic is we give away these things at zero. It can't possibly be a profit. How could there be a profit putting a piece of glass on batteries with a screen and electronics and selling it for $50 and then shipping it for free for most of their customers? How can there be a profit? Okay, I don't know if maybe they're selling the cell service. Maybe you have to buy a contract. Maybe there's something to it. But from what I understand, they're selling a $50 tablet. That's just idiotic, because all you do, first of all, you're cutting into your other tablet sales, not just by you, but by your competitors who also sell on Amazon. You're cutting into their sales, where Amazon makes more money selling an iPad for $1,000 than they're going to make selling their own thing for $50. So ideally, what they're probably saying is, well, if you have one of these pads that comes preloaded with some Amazon software, and then maybe you're going to buy stuff and blah, blah, blah. It's all garbage, though. It's just like, it's not worth the hassle to do it. If it were my company, I'd be like, well, don't sell it then. Just don't bother. We're Amazon. We sell all kinds of products. Why don't we make a deal with Apple to feature our software? Why don't we make a deal with Microsoft and we'll feature their pad if they have it preloaded with our stuff, or we'll give a discount and free shipping? I'd rather do that. Okay. In fact, if I was Amazon, what I would do is I would say, here's an Amazon insurance policy. You buy any tablet computer from us that's loaded with our software, And as long as you sign up as a Prime member, we will then insure your tablet against breakage and give you a brand new one. And all you got to do is put it in this handy box. We ship it to you. We take it back. And the next day you have a brand new tablet. That's what I would do if I was Amazon. Because you know what? Then I would get millions of people to give me $100 for insurance and for a Prime membership. They'd have their Prime membership, which they'd use and do the business with us. And then I just offset the insurance. I just go to Berkshire Hathaway and turn around and insure the iPads against breakage. So, very, very simple concept. But instead they're like sitting there with the worrying about, Jeff Bezos is running around some factory in Japan and looking at watching who's making his machines and getting ship orders and worrying about delays on screens and delays on parts and the logistics of shipping them out and so on and so forth for a $50 machine. Come on. That's just a waste of somebody's time in that company. It really is. Nobody should be doing that in that company. It's just not their core business. Deanna says, MRC is 12 weeks drive. They completed 9-2 with Phillips, a 5-year contract, option prospect. MRC? I don't want to constantly go back and start talking about individual companies here. I think some people would like to know what we'd like to do. But MRCs, all these guys, they're okay. They all look like bargains because they're cheaper than they were. That doesn't make them a bargain. In 2008, everybody looked like a bargain too. Okay, so MRC, they were 25 to 30, now they're 13. Okay, so now you want to take a look and you go into them and you say, well, what have they been doing with themselves? They're actually making money. That's a good sign. We like people who make money. Even quarterly, not too bad, but worse. They're clearly down. So we're talking about 29, 30, 45 here. So 45 in the first half versus 144 last year. So 90, you're talking about a 30-something% drop in profits here. So roughly about a 30% drop in profits from the last 2 years. They're back to where they were in 2012. Let's keep that in mind. They're back to where they were in 2012. Their payables are up from 2012. Their debts are up from 2012. Their cash is down from 2012. Their cash flow, not very exciting also, but not terrible. Nothing bad here. Obviously not good, but not bad. All right? So basically this company, if I had to put a number on it, I'd say, well, how much were they in 2012? So they're $1 billion now, and we'll take a look at them in 2012. Oops, sorry. Oh, can't see it there, so we'll have to go back to Yahoo. Hope it doesn't break. And here we go. And in 2012, they were $20. Oh, I can't. Oh, that's they IPO'd out here. That's why. Okay. So basically, they're making now what they were making in 2012. But in 2012, they were priced for growth. But they didn't grow. They're actually right where they were in 2012 as far as profits go. So it goes back to the same thing. Now, this becomes in a long-term kind of play, like CLF or something like that, where you say, well, as long as they can survive, we can assume that at some point the pricing will come back in their favor and they'll make some money. So if you want to play it like that, it's the same kind of play also. You want to just do a cheap entry. Okay? So you look at MRC, say, how can I get a cheap entry? Step number one. How do I get a cheap entry? I go out to March. They're at 13. I sell the 1250 puts for 155, 160. Let's say 160. All right, and that brings your net down to $11 or $12.90, I guess. $12.90, not $12.90. Sorry, $11.90. Nope, $10.90. Sorry, $10.90. So here you'd have a net of $10.90, and if you want to be gung ho bullish on them, then you can pick up the 1250 calls, which are in the money, for $220, let's say, or $230, and you sell these guys the $15 calls for $130, so that's $1. All right, so you take this 250 spread, 12.50 to 15 for $1. You sell the 12.50 puts for $1.60, so you're going to net a 60-cent credit on a 260 spread that's already in the money, on a 250 spread that's in the money. So you can make up to 310 if they get to 15. And again, why buy the stock? There's not really any reason to buy the stock. I don't think so. Anyway, they don't pay a dividend, do they? No, they don't pay a dividend. You don't need to own the stock. If you want to make a bet on it, instead of buying it and messing around at 13, here your worst case scenario is you still have a credit. So your net entry is about $12, so you're getting almost 10% discount on a net entry, and your upside is better than whatever the stock could gain for you. But as a play, would I recommend it? No, because it's not very exciting, is it? That's not a great. It's not just that I have to like a stock. I have to like a stock, and I have to like the option spreads enough to say, "Ooh, that's an attractive trade. That pays off really well." This doesn't pay off really well. It really doesn't pay off any better than if you just buy the stock. Okay, I wouldn't waste my money on the stock, but I wouldn't either, I wouldn't bother with the option trade either. It's just not that exciting. Okay, back here. What are the top 5 stocks you would buy on a pullback? Can I do that off the top of my head? IBM, Apple, GE, Taser, and iRobot. Those are probably my 5 best stocks, I think. So IBM, makes sense? Yeah. IBM, Apple, GE, iRobot, and Taser. Still long-term love Taser, long-term love iRobot, long-term IBM, long-term Apple, short-term Apple, any-term Apple, and GE is GE. I mean, it's how the world works. When you see a dam being built in China, the chances are it's got GE turbines in it. I mean, they're everywhere. They do everything, and it's a great company. So when they get cheap, they're worth buying. Now I don't even know where they are now, frankly, but IBM just had a bit of a turnaround today. But look, IBM, this Watson thing, unless somebody comes up with a better Watson than IBM, which I doubt, this Watson thing is going to basically change the entire planet. And not necessarily for the better, but but the bottom line is almost anybody who answers questions on the phone, like a basic customer service people, can be replaced by this computer. And that's millions and millions and millions of jobs. And you think about it from IBM's perspective, what's the cost of them doing this? It's like they wrote the program. Obviously Apple's doing with Siri now. I mean, you know how Siri works, right? You talk to it and answers a question. Watson does that, but it does it better. And it doesn't cost billions and billions of dollars to run Siri, and it won't cost billions and billions of dollars to run Watson. It's going to cost some fixed amount of money that's technically negligible. But how much do you make from replacing 10 million customer service people? You have 10 million people, and they make, let's say they make 25,000, let's say they make 20,000 a year. Let's say they're all in India. And they make 20,000 a year on the average. That's $200 billion. IBM goes to these guys and says, hey, you know what? I'm going to replace your 10 million customer service people for $500 a month. I'm going to save you 75%. IBM still gets $60 billion. And IBM says, hey, here's the advantage of using a Watson. After the initial training that your company sets up, so your company trains Watson like it's a person. It teaches Watson how to answer the phone, how to talk to people, what the answers to the questions are, using your company's database, how to find things, so on and so forth. That's all the company does. It teaches the machine instead of teaching the employee how to do stuff. Once you teach the machine, you have now taught every single employee in your company who answers the phones how to do it, because every single employee is Watson. If you get busier, All you have to do is order more Watson employees, more virtual employees, and they show up. If you're not busy, lay them off. IBM doesn't care. We say, you want to lay half of us off? You want to tell everyone not to come in on Monday? We don't come in on Monday. We don't get paid. We only get paid for whatever you use. So now IBM, because they're so generous, they only make $45 billion instead of $60 billion. It's almost all profit. And that's just replacing 10 million customer service people, and I bet you talk to 3 or 4 of them a day that you could think of replacing with a machine would be better. It couldn't be worse, right? Who you talk to on the phone. That's just that. Then you've got legal assistants, paralegals, the people who the lawyers say, go look this stuff up for me. That's their whole job, is looking stuff up and preparing reports. You teach a computer to do that, and now you've replaced millions and millions of jobs that are highly paid. The doctors, medical research, frankly, teachers. I'm sorry there's teachers out there. But I mean, think about it. You have teachers. You teach the thing how to be a teacher and how to answer questions for the students and how to help the students. And you can back those teachers up with real people, but you only have to back up, for every 10 Watson science teachers, you only need one Bill Nye sitting in a room somewhere, so in case there's a question they can't answer, it flips over to him and he goes, hey, Bill Nye here, how you doing? I'm going to answer your question. And you know what? You can pay Bill Nye $1 million to sit in that room. You can pay superstar teachers to sit in the room and answer the hard questions while the computer takes care of every single basic question. And not even in a normal way. Because the computer, when you ask it a question, can bring up first of all, a computer can teach an online course, and you can ask it a question, and it's as if it's individually teaching to you. It's going to sit there and help you do your work and help you learn individually and pay attention to everything you do and say. And it can do that with millions of students simultaneously. You can't compete with that as a real teacher. And if there's something complicated comes up, it just says, that's beyond the parameters of what I know in my human interface. And it's going to bring up a human. But you know what? 20 years from now, it won't need the human anymore. But don't tell the humans that. They'll be thrilled they have these jobs. Because IBM goes to these humans and says, hey, you're the best teacher out there. We're going to pay you triple your normal salary, and you're going to sit in a room, and whenever somebody needs you, your monitor will flash, and you'll flip into a live session with a student and talk to him. And that's all the teaching you have to do. The basic lessons are handled by the computer. And also your job will be, while you're sitting there, you're going to help the computer be a better teacher and teach it to be smarter. It's very flattering for people. They're going to do it. But they're going to do it. They're going to sign the death warrant for themselves and for all other teachers to follow. That's our future, folks. And IBM's making it happen. So either you buy IBM or you watch it happen and you sit there and say, damn, they're getting so rich. They're going to make billions and tens of billions, hundreds of billions, just insane amounts of money, but every dollar they make is going to throw people out of work. And the whole world's going to change someday, but who knows how. Meanwhile, the only thing I do know is I want to own IBM. All right, so there's IBM. Now, let's talk about GE. GE, like I said, they make everything everywhere. They're a worldwide conglomerate, and they flatline like crazy. They're great. They're great for the butterfly. I think we should add these guys to the butterfly portfolio because that's what they do. They just flatline at whatever price they're at. If they move to a new range, they stay in that range forever. They're perfect. They're perfect stock for a butterfly kind of play. All right, so that's done with GE. Apple, we know. Apple tomorrow, they're going to have the problem with Apple now is that they're 70% iPhone revenue. That's how the company's made up. There's all kinds of rumors. People may or may not like what they have, but no matter what they bring out tomorrow, it's not likely to move the yardstick very far from the fact that they are almost all dependent on the iPhone, and it's not very likely they're going to come out with anything so exciting in the iPhone that people aren't going to be nervous. So I think Apple may sell off a bit from where they are now, which is what, 112, 113. This thing says 111 something. Okay. So I think Apple's going to come back down, possibly back down to test 105. I do like it here. I like it here too. I like it here. I don't care where it is. I like it because long term, I don't care that they're almost a one-trick pony with the iPhone. I still like it. Until somebody comes up with a better phone, I still think Apple's going to dominate that space. I also think you're going to see Apple cars in the future, like And I don't think it's going to be the whole car. They keep saying Apple's working on the whole car, but I really don't think that's what they want to do. I think what they're going to do is have an environment of an Apple car so that when you get in your Apple car, it's configured. And people who don't have Apple won't know what this means, but people who have an Apple, a couple of Apples, they know that when they go into their house, everything that they did outside the house suddenly goes on the house computer. And when they leave the house, whatever they do on the house computer is on their phone. All their apps synchronize automatically. They don't have to touch a button. They don't do anything. Things just synchronize, and you expect it to the point where you don't even think twice about, like, why should something be there. People who get used to that, you also, when you find out you can do that with your car as well, and the act of you sitting in your car configures it to all your settings and all your preferences and all the stuff that you want for your car environment, as far as audio, video, everything else, that's going to be a very powerful sell. So that's going to be in the car. Whether they, make that into a whole car, I just don't see the money there. Although, you look at what Tesla's getting as far as market cap, it seems attractive. But as far as actual earnings, it's not very attractive. They're better off selling Apple environments to car people. Then we got iRobot. And again, it's all part of the robot revolution. Whoops. iRobot is our stock of the century because mostly because they had such an easy time to be a 10-bagger. When we bought them, they were $5 or $4. Now they're 30, so we only pegged them to go to 50. But my thought with iRobot was always one day. Well, they almost went to 50 right here, so that was it. I mean, basically we got out when they did this, and then we got back in when they went down here. The reason I thought they could go to 50 so easily is exactly why they did go up here. As soon as they get a military contract, and the Army says, the Army's got 2 million troops. Okay, so they've got 2 million in the field doing stuff. Let's say let's say there's 5 people in a platoon. So divide that by 5. So there's 400,000 platoons. Let's say 1/4 of those platoons divided by 4 gets a robot. Now, what does the robot do? They're going to want a robot that goes around with them and does stuff for them, like scouts and checks things out and diffuses bombs and so on and so forth, right? And let's say that, now first of all, I'll tell you right off, it costs $2 million to train a soldier. To train and deploy a soldier is a $2 million thing for the Army. That's their cost. Now, that seems ridiculous, and it probably is ridiculous because obviously ISIS deploys a soldier for like 75 cents. It does, it's just the way we do it, the way we do training, the way we do everything. It ends up costing the Army $2 million to put a soldier in the field. That's the cost of a fully trained soldier in the field. So iRobot, same thing as IBM now. iRobot says to the Army, you know what? We can give you a $100,000 robot that does almost everything a soldier does, except it's kind of dumb. Like compared to a soldier, it doesn't understand stuff, but it can certainly go out there and find a bomb and defuse it, and it can certainly look around corners and check for snipers and so on and so forth. So if the robot dies, it's not a big deal. If the robot steps on a mine, it's not a big deal. And the Army says, oh, that's great. So they will deploy a robot for every platoon. So now you've got 100,000 platoons that they choose to deploy robots with times a $100,000 robot, $10 billion. Yeah, I'm not saying iRobot's going to get all the contracts for all the robots, but they're in a fantastic position to get some contracts for some robots. And if you look at iRobot, here you go. So then if you look at iRobot, and you say, well, these guys, because they already have military contracts, they're already in the right places, they're already designing robots. If you look at iRobot, their sales are currently $500 million. Now, they even make money on it. Unlike many of these contractors, they are actually making money now. So they make money now. They're only doing $500 billion, and all they have to do is get one teeny tiny Army contract, and they can double and triple their sales. That was my logic when they were at $4, and that's still my logic because they still have not gotten a big Army contract. They have some little contracts, but they've never gotten a big Army contract. But that's the simple thing about it. This is a company that's poised to possibly do fantastically well. And unlike a biotech that might do well if they do this and that with a drug, these guys make money every month anyway. They're a currently profitable company. They're only worth $1 billion, which is a lot. They're worth 30 times or 25 times earnings at $1 billion. But they could easily, on a good military contract, they can pop this up and double it quickly. And that's what you want. You just sit in the stock until it does that, then you get out and you make your money. And the other one is Taser. And Taser is a similar situation. I mean, Taser, they just do, look, you can see it now in populations around the world. People are rioting more and more. The poor people are getting harder and harder to control. And more the rich people want to control the poor people. And one great way to control them without getting them too pissed off is to zap them with a taser. And Taser is, and also now we're recording the police because the police are getting too violent and blah, blah, blah. There's all kinds of things. And Taser's right on top of the body camera fad and everything else. Taser is a little bit pricey because their earnings are not good, but a lot of their money is being spent on R&D. Very good company, and I like them too. So whenever they get cheap, we like to buy them. All right. So there's 5 stocks, right? Let's see what else we got going on here. What is the sector that money is being rotated into? I think money is currently being rotated into the energy sector, and that might be a mistake. I see a lot of money going back into energy stocks, and the premise is very faulty. I mean, everybody thinks OPEC's going to get together and hold hands, and they have to. It's not just OPEC. OPEC has to get Russia on board. They have to get Brazil on board. They have to get Argentina on board. They have to get Mexico on board. Everyone's got to get on board because most of these guys, and Canada, and America's now producing more oil than OPEC. More oil than Saudi Arabia, not more oil than OPEC. We're producing around 11 million barrels a day, and Saudi Arabia produces maybe 10. So, what was I going to say? So they have to get everyone to agree to cut back on their production because any of these people right now are not producing at their top. Because basically there's a long-term destruction of demand that was caused by the high oil prices in the first place. Oil prices got so high that it started the solar industry, and it started people like Obama saying, world leaders like Obama said, hey, you know what? Our cars could get better mileage. Let's do that so we use less oil. And all of a sudden there was this whole steamrolling action of people using less oil. LED lights, better mileage cars, more alternate energy, solar energy, so on and so forth. And no more than 20 years from now, maybe 10 years from now, fusion. And they're going to be totally screwed. It's not a good long-term investment anymore. The energy sector, even the solar sector is not a good sector anymore because even as solar matures, it's kind of like the chip sector, right? The chip sector, except for Intel, pretty much, and maybe a couple of other small ones, SanDisk, memory. Generally, the chip sector has been a loser as an investment ever since they were invented. They pop up once in a while, but then they go back down because it's a commodity, and they make more and more chips, and they're better and faster every year, and it kills you because every time you invest in equipment to make the best possible chips, 1 year later, those chips aren't the best chips anymore, and now nobody wants yours because they're old. And that's where solar is. Solar just happens to be in the sort of dot-com days of chips, where those chips are still relatively, one guy makes a chip and another guy makes a chip, and this chip has some things that are better and this chip has some things that are better. They're not fully commoditized yet, but they will be. And when they're fully commoditized, then that's it. It's just going to be a mass production, who can knock them out the best, the fastest, the cheapest, so on and so forth. Now the problem with that for regular energy, for oil and stuff, is that means that those chips are going to get better and cheaper and more efficient and so on and so forth until there's absolutely no point in using oil. And in fact, frankly, if we had a big advance in battery technology, which we haven't had, batteries aren't the same as oil. Batteries function on a physical plane. And the physics of batteries means that if you're going to make an advance, the advance comes in like probably one big breakthrough, not like a little incremental thing like chips do. So with batteries, it'll take at some point there'll be a breakthrough in storage capacity. That will then be the death knell for all these oil companies. You know, I'm talking long term. I'll talk next month or anything like that. But the money going into the energy sector, to me, it's just wasted money, though. It's like, why would I start backing these energy companies when all they're going to do is blip up a little bit? Now, that being said, we have a few energy plays because we do think it'll blip up, but we're not going to stick with them. When they come up and they make us some money, we're going to get out and be like, good, so much for that sector, and we'll walk away. Unless there's a war. If there's a war or something happens, then it can go up. But I don't think even with increased capacity and even with more manufacturing coming online, I don't think energy prices are sustainable for the long term. I think it just is no longer a thing that's going to be expensive. What's your take on Terra, Nitrogen, TNH? I like those little specialty guys. You know, I like these niche players who make a certain product that's in demand. Terra's okay. You know, they pay a hell of a dividend. That's a nice thing about them. But they're $2 billion. And what do they do besides the nitrogen? Nothing. You see, it's so boring. They sell nitrogen fertilizer, ammonium nitrate, blah, blah, blah. It's a boring, basic company. Doesn't even say how many people they employ. They've been around for a while, though. I don't think you're going to see much variation in their volume, pricing, anything else. 780, 736, 648. They're dwindling. You know, I mean, if you look at it, they're actually making less than they were making. And part of that's because they pay such a fat dividend. They're giving away all their profits and not reinvesting in the business. On a quarterly basis, 168, 126, 153, blah, blah, blah. So they're going to drop, let's call that 160, 80, 160. Wait, no. 300. So they'll drop about 400 to the bottom line, 350 to the bottom line, let's say, be generous. And for $2 billion valuation, that's excellent. Forward PE, doesn't say over here, but it's very good. I haven't looked carefully at them lately, but I think on the whole, it's just a good, nice, boring investment, so I don't have anything against them, so that's my opinion. If you were going to play them, I don't think they have options or they don't have good options, otherwise I would actually play them at some point. No options. So basically, it's a nice company, it's a good investment, they pay a dividend, but it's going to be boring, it's going to be a grinder. You know, nothing wrong with that. I mean, there's room for those kind of things in your portfolios, but, you know, we never play it because it doesn't have options. If they did have options, I probably would like them for a long-term play because I could offset these little dips they have, okay? But, you know, you're just subject to the variation. And always remember that stocks that pay out a lot of dividends, they're not making money. They're giving away all the money they would have made in dividends. I don't know if there'll be an example of that in Terra. But if you look at the cash flow of the company, so look at these dividends, 300 million, 400 million, 500 million. What do they drop to the bottom line? Nothing. All right, so they don't reinvest in the business, and so instead of doing sales and marketing and improving their processes, they just sort of drip down. So this 10% that you're pulling out in dividends is the 10% less earnings they're making every year. You're basically drawing down the earning capacity of the company until there won't be anything left. They don't have a growth plan. They're not trying to build this company up. So it's kind of an illusion when you think that it's doing great because they're 111. It seems cheap, but they're 111 because they gave away $300 million to the freaking shareholders. They didn't make any money. They made zero because they gave every penny they made away. And they've done nothing to reinvest in this company's future. All right? So that's the danger of these kind of stocks. And so if I can't give myself an edge with the options, I'm not really interested in just plunking 111 down because all you're doing is you're not really even getting your 10% back. Because look at the guys who did do it. Where'd that thing go? Yeah. This guy paid 180. All right? He got, well, what's the number? All right, he got $10 back. So this guy paid 180. He got $10 back, but next year the stock's at 150. This guy paid 150. He got $10 back, and next year it's at 110. You're going to get 110. You'll get $10 back in dividends. and it'll be at 85, it'll be at 90 next year, or 100. Maybe it'll go up a little bit, but you're going to have to be lucky. These guys were lucky, but then it went back down anyway. These guys were lucky, right? These guys were lucky. Now it's coming back down to where they were. There's nothing. This is an accurate interpretation of where the stock is going. Every once in a while, it dips down to where it's going to be. And in fact, frankly, look at this pattern, because it sells off at the end of the year, sells off at the end of the year, comes back. So I would wait. If I was going to get in the stock, I would wait for the sell-off that comes in about a month or two. Then I'd get in. Then I'd get the hell out when it goes up. I wouldn't start thinking I'm a genius. I'd say, well, that's the damn pattern for this stock. All right, but like I said, without options, I have zero interest. It's just, it's just something that's there's no good way to play it and take advantage of it. Wayne says, any news on BHI? No, it seems to be just moving along. And is BHI still playable? I think so. I think that there's probably still bargains to be had. BHI. I mean, I just called it last week on TV, so I don't see why not. Yeah, well, I called it last week because it was here, though. When I called it, it's funny because I went into the TV studio this day when it was all crashed. And the next day it started shooting back up, and unfortunately they taped me because it ran overtime, and they taped me, so it didn't air until it was already back here. But you know what? Even here you can still put together something. Yeah, what happened? Oh, here we go. Our premise on BHI is it's going to go for more than $55. So it's at $55. So if you say, okay, well, if it's going to go for more than $55, and I could sell these $50 puts for $6, right? This is 505. You can get 6 because see these are 460. If these are 460, how could these be only 505? That makes no sense. All right, and also you can see it goes between 385 and 7. So I'd say 6. Well, certainly for these you get 6. Here's 5 and here's 770. So you get $6 for the 50 puts. That's $44, and we think it's going to go over 50. So then you say, well, what can I do with my $6 now to leverage it up some more? So you take the 45 puts. Now that's an ugly spread. Wow. Well, figure you take the 45 puts and let's call it $13.50. That's tricky. Call it $13.50 for those. And how much do you have? You have $6, so find something you can sell for $7. And that would definitely be these guys at 55. All right, so the 55 you can sell for $7.50. So if these are $13.50 and these are $7.50, that's exactly $6. And that means you have a no-cost 45.55 bull call spread. Okay, and so if they get called away, if the deal gets done above $55, you make $10. That's not bad. I'll take $10, and it probably will close this quarter. In which case, you're going to get $10 paid real fast for that trade. Costs you nothing. You make $10. Very simple. You sell the $50 puts for $6. You buy the 45.55 spread for $6. That's net cost 0, and $10 you make if you get called away over 55. That's a nice way to play it. Where are we? Yeah. All right, last couple of questions. I got to get the hell out of here. Is this still a valid play on RJet, the one you have in 5% portfolio? Yes, I just said that today. RJet, we like it. Look, again, they're being priced as if they're going to be bankrupt, and all it is a pilot strike. Big deal. Reagan had a pilot strike. He fired all the air traffic controllers and got new ones. It wasn't pilots, it was air traffic control. But anyway, so there are pilots out there. They'll settle with the union. They might not make as much as they made when they were here, but they're certainly going to make more than $3. All right, so I like them down here. I think they'll get back to 4, which is, I think, our target is $4. So I think once they settle the strike, they're going to fly up probably higher than 4, but I'm just taking a very mellow spread, and so far it hasn't really picked up much in cost. And would you consider TF a short 1160? Well, here we are. Now we can look at the futures again, see if anything's happening. Oh no, not with these. Not when everybody's breaking up. Are you kidding? you gotta say the momentum's certainly against you here. Everybody's breaking over their resistance lines in a huge way. This is now becoming a big rally. We're talking about moving like 2.5% almost on this. And at the 2.5% line, I would probably consider a short for a small pullback. But this is a runaway thing. You can't short this. And by the way, somebody must have said something here at 12:50. I don't know who said what. Let me take a quick look at the news and see if I see anything. But the indication here is that something happened at 1 o'clock. I don't see it. I don't know. That kind of action is the kind of thing you usually see if like somebody from the Fed says something or something. But meanwhile, you see these lines? Look how nice that is. Right off that line, boom, and it bounced back up. Off that line, boom, and it bounced back up. Off this line, boom, and it bounced back up. Obviously, these lines work really well, right? Generally, you had two confirmed moves off that line. So even though he wasn't there, it doesn't matter. You know the Dow's going to move with the other indexes. He was there, and you can make that play normal. You can make the play higher here. Now, meanwhile, I want to check the volume, so I want to take a look over at SPY and see how they're doing. SPY. And the volume sucks. So the entire move is meaningless. Average volume, 139. Volume, almost 3 o'clock, 65 million. Now, you do get a big burst of volume, probably 50% you can add 50% to the volume for the last hour, but it's still going to be 90 million bucks. I mean, it's 90 million bucks. It's still going to be volume of 90 million, which is still 30-something% below a normal day. And that means that you can't take this move seriously at all. So that makes me more inclined to say at 2.5% lines, I wouldn't mind shorting. And you can short at 1160 if you want to be brave about it, but you're really fighting some dangerous momentum. So you just got to be aware. It's like, yeah, take a poke, but make sure you have a reasonable stop in place that you're not going to get yourself burned. 4,300 probably fail. 1965 is probably going to fail. 450, that's been a good line to fail also. So all these lines, especially when you know you're over the second resistance line, that doesn't usually happen anyway. So you have a good chance of it coming back in. If I was going to play this, though, I think I'd rather play this with a TZA or something like that, just to play it into tomorrow. I wouldn't want to risk the options overnight. But if you want to set up a trade, you just go, you take TZA as a proxy for shorting the Russell, TZA, which we already have in the short-term portfolio. Oh, I wanted to check that. And you want to do an overnight. I'd rather go out to October so I don't get too burned. And here you go, the October 11s. We're at 1150. The October 11s are 90-something cents, just sold for 90 cents. And they have a 50 delta. All right, so if TZA starts dropping, you're going to make 10%, 20% on that trade. So I'd rather do that with these are the 12s. I'd rather do that with the 12s because if they fall, they're only going to lose a little bit. Like today, TZA moved 75 cents. So if it moves 75 cents, this would drop like 40 cents. So I'm risking losing 40 cents. And if I do, then I would actually feel better about like rolling this position into something a little more substantial. If I have the futures, though, I could lose thousands and thousands of dollars and be upset about it, and then it's hard to reposition if you get burned. Because you're really at the mercy of whatever statement one of the central bankers wants to make overnight if you start playing with the futures. So I certainly wouldn't want to play with this thing overnight. 1160, if it holds, it's good. It could pop up from here. What's going to happen is you'll see tomorrow these things will widen up because it went outside the range. So these will widen up tomorrow, and maybe the purple line will move way up here to the middle, and now you're going to be looking at 1170 or so could be the highs. And obviously this thing's been pushed and pushed all day on low volume, and there's no reason to think that we're going to have a high volume sell-off to counteract it. So that's where we're going to be on those. There's just nothing here that's exciting enough to play, unfortunately. All right, so I'm going to wrap this thing up now. I think that's about the end of it. Oh, I know what I wanted to look at, though. One thing I wanted to look at first. How is it, we were talking about before, the long-term portfolio. Let me refresh it and see how it's doing. It was 40.4%. I'm refreshing it, and now it's 40.3%. So the long-term is holding steady at 40.3. The short-term, whoa, 223. That's fantastic. The short-term portfolio, I don't know why, but for whatever reason, has actually gained $10,000 since we looked at it earlier. Hang on, let me check that number. Maybe I'm wrong about the number. It seems like a lot. No, it was 311,884, and now it is 323. So I'm right. It gained $12,000 since what time is that we reviewed it? We looked at it at 10:30. So since 10:30, even though the market's going up, the short-term portfolio has gained. And that's because we're not bearish enough, frankly. I mean, I want it to be more bearish than this. So we're going to have to take a look at our positions and figure out why this is happening to us. And it's tedious because, you know, we were very well balanced, and then we sold a lot of our positions to get back to cash. And now it's like I'm not quite sure in a bull market which positions are doing what. So we're going to have to learn, oh, I know what it is. Look at this SCO. We didn't get rid of all these SCOs. That's part of it, because the oil popped up, and that certainly made the SCO position better. In fact, I can tell you right now, at 10:30, those SCOs, there's $3,000 of our profit comes from this SCO position right here. So what we have to do, you guys don't even do it, I do it. What I have to do now is go through all these positions and look at how much money we made since 10:30, and I can see where we're too bullish and where we're too bearish. Because we got to look at that, and we have to figure out, because we don't really want to make $11,000 here while the long-term portfolio is also making money. That's not good, because it means that we're too bullish. It means that when the market goes down, we're not covered. So in all that unwinding, we unwound a lot of positions last week and went to cash. Look at this, we have $332,000 in cash in a $320,000 portfolio. We have more cash than we have in position value. I mean, and the total net of the portfolio is all cash. It's beyond all cash, basically. And the same long-term portfolio, we have more cash than we have value in that one, too. We are sitting on tons and tons and tons of cash, and we got to see where to deploy it. But first of all, we have to see where our balance points are. We have to see where we're too bullish, where we're too bearish, and we're going to have to make some adjustments. I certainly didn't want to start doing that today, and I'm not going to. But that's the point of doing these tracks, is I want to see now what changed from 10:30 until 4 o'clock. I want to see what changed, where we made money, which positions made money, which positions lost money. And obviously, since I know the market went up since 10:30, or it was flattish, basically, I want to be able to take a look and see, okay, are we in the right track or the wrong track? All right, so that's how we're going to look at it. Meanwhile, though, the balance is perfect because last week we were much lower. So I think today's like a $20,000, $30,000 update overall in two portfolios, which is crazy, especially considering how we hardly have any. It's not like we don't have positions. We obviously have a lot of positions, but we have no cash in the positions. Everything is hedged against everything else. To the point where we have no actual cash in play. It's all just margin requirements to run these positions. All right, so that's still, you can win and lose on those, but the bottom line is we have so much flexibility with this setup right now that we can do anything we want, but we also have to know what we want, and that's going to take some figuring out because we had it perfectly balanced going into the cash out. We were very, very perfectly balanced. We knew exactly how much we were going to make and how much we'd lose on every market move. But now that took us. That took us all year to put that balance together. I mean, it's a little bit of, it's like Jenga. It's like a little thing here and a little thing there, and you watch it teeters a little, you put it back in. That's what constructing these portfolios is like when you have a lot of counter hedges. We had a perfect balance. Now we don't. You can't delude yourself. We don't know what our balance is now because we haven't tested the new positions yet. I mean, they're the old positions. We haven't added any positions, but now it's a different combination because we've taken out some of those Jenga pieces. And now we've got a tower that we're not positive is going to stand up as well as it did. And God forbid, right, we took out the wrong pieces and the whole thing falls over and we lose 30 or 40,000 bucks on a 2% market move, we'll be very pissed off. All right, so the fact that we made $30,000 today isn't good because it means we can lose $30,000 tomorrow, and we would rather be a little bit more balanced than that. So I'd say for sure we're too bullish. Too bullish is pretty easy to fix, but we just have to pick our spots and do it right. All right, so that's where we are now. In fact, into the close, I'm probably going to make a little bit of a bearish call and do something, but I'm not sure what. But I imagine I'm just going to want to add to TZA or SQQ or something like that, or SDS. I'm going to change one of our existing positions. I'm not going to, do anything drastic. I'm probably just going to change one of these positions to get more bullish. That would be my plan. In fact, possibly buying out these short calls. Yeah, buying out these short calls is one good way to do it. Here we have more short. Oh, I see. Here we have 27. That's weird. So yeah, buying out both of these short calls, because you know why? It doesn't cost us anything. We have $5,000 worth of short call. No, we have $2,000 of short calls here and $1,500 here. And if we buy them both out, we make ourselves much more bullish. That's what we're going to do. These September SDS short calls, all 100 of them, it's going to cost us $3,500 to buy them out, but that makes us so much more bullish because now we have uncovered 100 SDSs. All right, and if we keep going up tomorrow, we're going to take our SDSs and we're going to roll them into a longer position. All right, so that's officially what we're going to do. And I will now announce that in chat as I get back to it. And thank you guys all for coming to this meeting. It has been fun. Oh, TZA is about to do split. Yeah, but isn't that October? Somebody told me it's not until October. True or false? Do we know? Let's find out before we do that. TZA reverse split. Ah, come on. April, August, 4 days ago. Yeah, I was going with somebody told me it wasn't until October, which means we got plenty of time. Ugh, stop loading stuff. May 20th, that doesn't do us any good. Ay, ay. All right, Drexion, here we go. Search by ticker, TZA. TZA. Related reading. Nope. Nope, sorry, I don't have it. As far as I know, though, it's not until October is the last thing I heard. And none of you guys answered it, so it remains a mystery, but I will try to find out in chat. October 1 or, okay, thank you, Alistair. Appreciate it. All right, so it is until October, so it can be played as a short term, and you're right, though. Here's the thing. Wait a minute. Why are we even talking? You guys are so confusing. All right. I was talking about buying out. What the hell were we talking about? Oh, buying out these. You know what? Did I say SDS? I can't. I'm talking about buying out these guys, these SDSs for $1,550. Buying out these SQQs for $2,000. So that TZA was a completely off-topic thing that had nothing to do with this play. The September short positions, SDS and SQQ, we're going to buy those out for $3,500. That turns us much more bearish at this particular position on the S&P and the NASDAQ. Okay? The TZA has nothing to do with it. Okay? But by October, we're going to get out of these because we don't want to be there for the split. So we will be exiting this position, but that has nothing at all to do with what I'm talking about. All right, thanks. Now I understand where this conversation went wrong. All right, guys. Thank you so very much, and we will do it all again next week. All right? See you back in the chat room.